Non-recurring items are gains, losses, revenues, or expenses that are unusual, infrequent, or unlikely to persist in future periods. These items are important in financial statement analysis because they can significantly distort reported earnings and obscure the true operating performance of a company. The program emphasizes that analysts must distinguish between sustainable earnings generated from normal operations and temporary items that are unlikely to recur. Proper treatment of non-recurring items improves the usefulness of financial statements by helping investors assess future profitability and cash flow potential. Understanding these adjustments is essential for valuation, forecasting, ratio analysis, and evaluating earnings quality in both IFRS and US GAAP reporting frameworks. One major category of non-recurring items involves discontinued operations. A discontinued operation represents a component of a business that has been disposed of or classified as held for sale and whose operations and cash flows can be clearly distinguished from the rest of the company. The financial results of discontinued operations are reported separately from continuing operations to help users evaluate ongoing profitability more accurately. Analysts generally exclude discontinued operations when forecasting future earnings because these activities will no longer contribute to future revenue or cash flow generation. Proper separation enhances transparency and comparability, allowing investors to focus on the company's continuing business activities rather than temporary gains or losses associated with divestitures or restructuring decisions. Another category includes unusual or infrequent items, such as restructuring charges, litigation settlements, asset impairments, natural disaster losses, or gains from asset sales. According to the program, unusual or infrequent items are reported before tax and above income from continuing operations. Analysts must evaluate whether these items are genuinely non-recurring or whether similar charges appear repeatedly over time. Some companies may label recurring costs as special to make operating results appear stronger than they actually are. Therefore, careful examination of financial statement notes and historical reporting patterns is essential. Identifying the economic substance of these items helps analysts assess sustainable earnings and improve the reliability of financial forecasts and valuation models. Changes in accounting policies and accounting estimates also affect the comparability of financial statements. The program explains that changes in accounting standards, accounting methods, and corrections of accounting errors generally require retrospective restatement of prior period financial statements. This approach improves comparability across reporting periods by presenting historical data consistently. In contrast, changes in accounting estimates are applied prospectively because estimates naturally evolve with new information. Examples include changes in depreciation lives, warranty assumptions, or bad debt estimates. Analysts should evaluate the reasons for these changes carefully because they may materially influence earnings trends, profitability ratios, and management credibility, especially if changes appear designed to manipulate reported financial performance. Non-recurring items have important implications for earnings per share, profitability ratios, and valuation analysis. Because these items often have significant one-time effects, including them without adjustment may overstate or understate sustainable operating performance. Analysts commonly calculate adjusted earnings measures that exclude unusual gains and losses to estimate normalized profitability. This process improves forecasting accuracy and supports more meaningful valuation comparisons across companies and periods. However, analysts must avoid automatically excluding all non-recurring items because some expenses, such as restructuring charges, may recur frequently in practice. A thorough understanding of the company's business model, industry conditions, and management behavior is therefore necessary to determine whether adjustments to reported earnings are appropriate and economically justified. The analysis of non-recurring items is closely linked to evaluating financial reporting quality and detecting earnings management. Companies may strategically classify recurring expenses as non-recurring to improve reported operating income and meet analyst expectations. Large one-time gains may temporarily boost profitability and stock prices despite weak underlying operations. Analysts therefore examine disclosures, management commentary, and historical trends to identify aggressive reporting practices. Transparent reporting of non-recurring items improves investor confidence and supports fair valuation in capital markets. A strong understanding of non-recurring items enables analysts to distinguish between temporary accounting effects and sustainable business performance, leading to better investment decisions, more reliable forecasts, and improved assessment of long-term corporate profitability and financial stability.